Markets reacting sharply to the latest strikes between Israel and Iran. Oil prices spiking and global stocks taking a hit. Here with our market insight is Bank of America Securities Head of U.S. Equity and Quantitative Strategy, Savita Subramanian. Savita, you were already less enthused, as I understand it, about stocks than you were at the beginning of the year. Missile strikes can't be adding to your enthusiasm. What are your feelings now about the stock market?
Yeah, I think it's getting even more complicated. And what's interesting is I think the one area that we liked at the beginning of the year continues to look attractive, that much more attractive, which is value stocks, large cap value companies like financials, like energy. Energy is, I think, a great place to be in an environment where you've got geopolitical strife. These stocks are barely trading above their long-term average multiples, and they're paying a very healthy dividend, a healthy inflation-protected dividend. So, I think there are spots to be within the S&P 500, but I worry that, for the next few months, it could be a very volatile market.
Next few months, there's that saying, sell in May and go away.
That's right.
I missed the opportunity there. Is it time to, sell in June and vacation in Saskatoon or whatever the saying is? I can get 4%, 4.5% in treasuries right now. Should I be hiding out or do you think the stock market continues to plug along?
Look, I think the risk in treasuries is manifold. So if you think about where the leverage in the United States resides, it's not sitting on corporate balance sheets. It's not even sitting on consumer balance sheets. It's really firmly on government balance sheets. And we really don't have a great solution for how we're addressing the deficit today. On top of that, the U.S. is starting to look a little bit more volatile from a policy perspective. And I think what's strange to me as a market strategist is I follow the U.S. I never had to think about a country risk premium before. And now, all of a sudden, it feels like there is a very real reason to worry about sovereign credit versus prior cycles.
With stocks, overseas stocks are suddenly outperforming. People used to say diversify overseas. It was like eat your vegetables. I don't want to. I want to stay in the U.S. But now it suddenly looks more appealing.
Yeah.
You say you prefer the U.S. here. Why is that?
Well, I think that the U.S., for the most part, as an index, just looks a lot higher quality than other equity benchmarks. So, for example, if you look at various factors like just financial leverage, U.S. companies have largely paid down their debt. They learned during the financial crisis that leverage is evil, floating rate risk is evil, so they really locked in very solid balance sheets. There's a decent chunk of the S&P 500 that is sitting on net cash versus debt. So I think those are some of the areas where the U.S. has really become higher quality at a corporate level. When you think about consumers, the consumer continues to spend no matter how much we think they're going to roll over and collapse. And I think that's a function of just jobs being still pretty healthy. We have a tight labor market. Maybe it's getting a little bit looser, but we have tighter immigration. We've got demographics all fighting against the labor pool. And one thing I've realized with U.S. consumers is we don't stop spending until we lose our jobs. We don't really care about savings rates or, the cost of capital elsewhere or how much it costs to borrow. We spend until we lose our source of income. So that's what we're watching to make sure this consumer story goes on.
I should not be laughing about the lack of savings, but I'm sure you're right. Let me come back to what you said about large cap value stocks. All the glamour is in artificial intelligence and the gobs of money being spent right now. So why would investors prefer value stocks here to growth stocks? Just that they're cheap?
Well, a couple things. So one, growth stocks have very high expectations. In fact, if you look at analyst estimates for long-term growth for the Magnificent Seven, these are companies that are forecast to grow over the next 5 years even faster than they've grown over their entire lifespan. So I think this is just an unrealistic expectation. These are companies that have to spend on CapEx. They have to remain competitive because China has really been amping up their AI focus. So when you look at U.S. mega cap tech companies or the hyperscalers, the ones that are fueling this CapEx cycle, these are companies where if they don't spend money, they're really in the penalty box because they're considered to be, ex-growth or not as competitive and risking obsolescence risk. In fact, during the last earnings season, what I thought was interesting is that if a hyperscaler guided down on CapEx, they underperformed. But if they guided up, they outperformed. So what does that mean? Well, they're drawing into their free cash flow. And that is not necessarily a great environment to be in when the cost of capital is rising.
I always learn a lot speaking with you. Thanks, Savita. Nice to see you.
Thank you.